Hi class, and welcome to this video, which is part of the Year 12 Economics suite of videos, and we're going to cover economic growth in this video. And this is part of Unit 3 Outcome 2 Macroeconomic Goals. And in this video, I hope that you achieve a number of learning intentions, and I hope that you understand 3 key knowledge points. I hope that you understand what we mean by economic growth, and we're going to particularly focus on gross domestic product, and understanding why we want it to be strong and sustainable. You can understand how to measure economic growth, and we do this by using real gross domestic product. And then we're going to hopefully understand the reasons why we are spending so much time thinking about this metric and understanding the reasons for pursuing strong and economic growth, because there are a number of benefits, including lowering the unemployment rate, growing real income, and the increased ability for governments to provide lots of services. As I mentioned, this is part of Unit 3 Outcome 2, and it is part of getting near the end of this series of videos, and you can see we have our 3 key knowledge points there. So the first one is that I want you to understand is, what do we mean by economic growth? How do we measure it? And what do we mean by these terms strong and sustainable? And probably in particular, this word sustainable, why we have that one there. When we talk about economic growth, we are referring to the increase in the amount or level of national production that has occurred. And we measure this by gross domestic product. So we're trying to understand how much has there been an increase in the amount that a nation or an economy can produce. And you might intuitively say, well, of course we want our economies to grow. We want to be able to produce more. And that is correct. But we do have a more specific goal that governments and economies outline. And that is to promote an economic climate that is conducive to high levels of sustainable economic and employment growth. So there is a key word there, sustainable, which is really important. Yes, we do want to have high growth and we do want to have high employment growth, but we want it to be sustainable, so we don't actually want it to be really, really high. We don't want it to be too high, because high growth can create some things that aren't actually ideal. And some of those implications or consequences of growth being too high or excessive is we might have inflation that exceeds our acceptable range. And if you're a bit unsure about inflation, I have a video on why we should be keeping our inflation around 2 to 3%. It can put significant pressures on our current account deficit and net foreign debt, which are topics in Unit 3, Outcome 3. And it could lead to an overuse of our nation's natural resources. So we typically say that our economic growth is hopefully going to be within the target of about 3 to 3.5%, maybe 4%. So our economy is going to be growing by 3 to 3.5%. So producing 3 to 3.5% more goods and service in terms of their value. So we're still growing, but it's not unsustainable. We can plan for it, and we're not going to have those negative impacts. Now, it's important to understand when we talk about this term sustainable, that this sustainable rate of growth can vary over time. So I have given you that figure of 3 to 3.5%, but it could vary over time. So we don't worry too much if it's at 2 or 4, because if productivity growth, for example, is really high, it can be higher than that. And in fact, also for the last pre-COVID years, economic growth was not really getting to 3% in Australia, but we weren't too worried about that because of other things as well. So we need to be considering the international growth rates. And for example, that was internationally, growth rates were quite low or dampened in prior to COVID. So we were happy for Australia to be growing at 2%, because that was actually beating most of our international competitors. What we really need to be thinking about when we talk about economically sustainable development or economically sustainable growth, we need to be recognizing that we want growth or development that meets the needs of our present generation without compromising the ability of future generations to grow and meet their own needs. So that's why we want our growth to always be sustainable. Then the question is, how do we actually measure it? You might have heard of this term real gross domestic product or real GDP, but what actually is it? How do I measure it? We know it's an important metric, but what actually does it involve? We know that gross domestic product, and in particular nominal GDP, is used to measure the amount of production taking place in an economy. Its definition, its specific definition, is the final market value of all goods and services produced over a given period. So, for example, if this is for a year, we're going to think about what is the final value of all the goods and services that have been produced in Australia over that year. And that will be a massive number, because if you think about all the things that are produced in an economy like Australia in a year. Because we are doing the final market value, we are actually calculating the value added during each of the production processes. And this is what we call nominal GDP. We are going to be saying the gross domestic product, the value of everything that has been produced at its current prices in total. Now, this is a very important number, and it's calculated every quarter, so every 3 months, by an organisation called the Australian Bureau of Statistics, and we often quote it in absolute dollar terms, so how much have we produced, and also the percentage change from the last period. And it's really important because we know that growth is going to have tangible, so meaningful and touchable and realizable effects on things such as employment, income, and living standards. Now, because of this, we do actually want to recognize that inflation, so price rises, will actually artificially increase the value of our gross domestic product. So we often try and remove that, and that's why we're going to focus on something called real GDP. So what is real GDP? Or you might see in the statistics or charts, chain volume measured GDP, which is the same thing. This is the most widely used measure of economic growth, and it reports an estimate of the real GDP. It removes the impact of price changes compared to the previous figure. So in simple terms, we use the prices from the previous, and I know that's misspelled, I'll fix it up so I feel a bit better, using the previous period and applying them to the current period production. So if we think about it simplistically, we're going to think about how much has been made in this period, but then to work out the value of that, we're going to apply the previous period's price levels. So we're not being artificially rising our GDP due to price rises, which we know can have some, particularly high price rises can have some negative impacts because it reduces our purchasing power. When we do this, when we look at real GDP using previous prices, we're actually going to hopefully be starting to see positive changes. So any increases should be representing positive changes in income or wealth generation and material living standards. So if real GDP grows by 3%, hopefully material living standards are going to be rising by 3% as well, particularly if we are using something called real GDP per capita. So how do we calculate this? To determine the gross domestic product rate, we are going to determine our gross domestic product at the end of our period minus the gross domestic product at the beginning and divide it by the gross domestic product at our beginning. So for example, and we are going to use the seasonally adjusted, just because that takes away some seasonal implications. And you can see here, seasonally adjusted takes out seasonal factors that impact GDP but hide underlying changes. So for example, if we're looking at the December figures, we know that there's often a bump because lots of things are being produced for Christmas. We remove that out of our figures, and you can see the December number goes down quite significantly because of that, which is relevant. So to determine, for example, the quarterly growth of June quarter, I'm going to find the June quarter GDP. I'm going to subtract it from the March quarter GDP. So I'm going to subtract March from June and then divide it by June. So we're going to go 1 minus 2 divided by 2, which gives me negative 7% quarterly GDP. If I'm looking for the annual one, I will go all the way back to June 2019 to get my beginning figure, which I do here. And you can see that my negative GDP was 6.3%. So significant reductions in gross domestic product in the quarter of June 2020 and the year to June 2020. Why is this such negative? COVID significantly impacted gross domestic product in 2020 and 2021. So what do I need to know in terms of measuring? Because we're going to go through some facts and some figures in a second. You do need to be able to define real gross domestic product or the chain volume measure. You need to understand what it is. You need to be able to quote the data. So you need to be able to know what the gross domestic product is in a particular period and understand the implications for this. Now, you don't need to know how the Australian Bureau of Statistics arrives at those figures. You don't need to calculate a specific figure, but you do need to know what those figures are over the relevant time period that you're being asked to talk about. So here are the actual current economic growth or real GDP figures, all the way up to December 2021, because the March quarter of 2020 has not come out yet. Here we see it as on the left-hand side. So the level is the blue line, and that is looking at the right-hand side. And you can see by 2020, our gross domestic product is about $520 billion. Probably more important to us, we are more interested in the quarterly growth figures. And you can see leading up to 2019, if we look to our left, we always had positive gross domestic product. We always had growth. In fact, we had very few negative periods in our history. What you might notice is they were not very big, barely 1% per quarter. And then we noticed something that happened massively in March 2020, June 2020. That was COVID. A giant reduction in our quarterly GDP, and then a recovery as we started to recover from a lower base. So you can see it took us a long while to get back to where we started, but we did have some growth. And then unfortunately, we had our second COVID wave with lockdowns, and then a big bump in December 2021. So you can see the volatility of COVID has equaled volatility in our GDP. When we've had lockdowns, it's been negative. As we've gone from a lower base, it's risen as we've come out of it. But you can see on a whole, there's been negative growth due to COVID, and now we're getting into a period of higher growth again, hopefully. So where can we start to be seeing some of these numbers? You can see we have our quarterly figures here. You can see our GDP was quite volatile, but with a very good number in the December quarter of 2021 of 3.4%, coming out of our COVID lockdown June 2021. Our yearly GDP is a high 4.2%, which is actually quite a good number above target. And you can see that we break this down into GDP per capita, so per person, because GDP can sometimes go up due to population increases. So we're actually interested in how much per person has there been an increase. And you can see that there's a number of data here that you can have a look at to really understand the data. We won't go into all of that. What you can see here is that often GDP is driven by two parts of the economy, public and private demand. So public, we are talking about our government sector. Private, we are talking about our businesses. And you might suddenly start to see what was driving our really large reduction, the fact that businesses couldn't open. This was offset a little bit by governments trying to support it with producing themselves, creating demand, providing, doing things that they could do. As COVID lockdown stopped, businesses were able to open, and the orange private demand increased again until we had our second lockdown. You also might be interested to see which states have really driven the fall and the recovery by September 21. Which states were most impacted by COVID? New South Wales and Victoria. So they were the ones that drove the September 2021 reduction, but they've driven the recovery as well. So you might want to have a read of this slide. This is some information from the Australian Bureau of Statistics. You might see that jurisdictions coming out of the lockdown drove growth, and we had a very strong December quarter with a 3.4% rise. This followed the fall of 1.9%. So understanding that this volatility has thrown our numbers up a little bit. And when you have a fall of 1.9%, often you get a bump up the next time because you've come from a smaller base. So it's important to understand that as well. So then we come to, why do we care? Why are we pursuing strong and, importantly, sustainable economic growth? We are doing that for a number of reasons. We are going to focus on strong growth leads to a lowering of the unemployment rate, leads to growth in real income, and allows governments to provide essential services. So here are the four that we're going to talk about. Why does Australia pursue economic growth? Growth in real income, lower employment, increased provision of services by government, and we'll talk quickly about a sustainable trade balance as well. So all governments pursue economic growth, but the primary means to improve living standards. Why do they do it? Why do they want to see good growth numbers? Because we know strong growth numbers can boost living standards, because a growth in production leads to a growth in employment, a growth in income, and if you have more income, you can buy more things, so you have enhanced living standards, and you're probably feeling better about yourself, so your non-material living standards improve. So we know it improves the quality of life, so economic growth can enhance the quality of life, your non-material standards, by boosting your happiness and self-esteem. And growth generates tax revenue, which governments can spend to provide all the important goods and services that they provide, for example, education, healthcare, and a welfare safety net. So how can economic growth increase income? Income is what we use to buy our goods or services. Now, economic growth can help to raise real incomes because, as we mentioned, growth in production leads to a growth in employment because businesses need people, labor, resources to build their goods and services. Growth in employment will lead to growth in income because there will be more demand for labor, and this can increase your living standards. Now, you might notice that they're typically been growing in a generally consistent manner, but you might notice that gross domestic income, the black line, was consistently lower from 2012 to 2016 than gross domestic product. So what does that mean? In that period, even though our growth numbers were long, people individually might not have felt that secure because even at one stage, their income was dropping. So their purchasing power, the ability to purchase goods and services was weak. You also notice in COVID, both really had a tough time. We also know that theoretically, if we have strong growth, we should have low unemployment because economic growth creates jobs. And if it creates jobs, it will lower the unemployment. As shown in our figure below, when we had weak GDP or lowish GDP, especially around this period, our unemployment rates, you could see, started to get higher. And you would expect that to occur and you can see that our unemployment rate has progressively gone down up in 2020, in which case it became really volatile after COVID because many people couldn't work. And it's a little bit hard to work this through. Now, one that we haven't really talked about is inflation. Economic growth, we do know affects inflation. Rapid economic growth particularly can lead to inflationary pressures. And if you're wanting to learn a little bit more about inflation, I recommend you watch that inflation video. The final one that we wanted to talk, I think the second final one is strong growth allows governments to provide essential services. Economic growth strengthens the government's ability to provide services and avoid rising levels of debt because growth means they'll have more tax income. So solid rates of growth around that 3% help strengthen the government's financial or budgetary position. They might even be able to have some budgetary surpluses, which we talk a bit more about in Unit 4. This occurs because as growth happens, people's income rises, and people's income determines often how much tax they must pay. So automatically the government collects more tax revenue because of personal, company, excise, sales tax, all the taxes that they collect. So more tax revenue makes it possible to finance all the government services that they want to provide, including education, health, housing, transport, defence and telecommunications, without having to borrow money, which they have to pay back with interest. So you can see there is a really strong incentive for governments to get strong economic growth because they can provide services to their citizens, which will raise the living standards of their society without having to borrow money, which can put them in a little bit of a risk in the future. Finally, you might want to have a read. I'm not going to go through this one too much. Economic growth affects our trade balance. And we talk a bit more about that in the terms of trade in Unit 3, Outcome 3. But for now, I hope that you've found this video useful and it's helped you understand why governments have the goal of strong and sustainable economic growth. We know that we measure this using real gross domestic product, and we understand what that is and how to calculate it. And we understand that having strong and sustainable growth has many benefits, such as lowering the unemployment rate, raising real income, and allowing governments to provide lots of essential services. Hope you found this video useful, and there's many videos in this collection that cover the domestic macroeconomic goals.